If you're past the age of 60 and you maintain a checking account, there are three compliance realities that the IRS and the financial system are actively applying to you at this very moment. And not a single one of them arrived through your front door as official correspondence. No announcement was mailed out, no informational flyer was distributed, just updated regulatory guidance sitting quietly inside examiner handbooks that the overwhelming majority of older Americans will never come across. I'm going to walk you through all three of them today. The figure you were told to keep an eye on that no longer captures the full picture. The routine cash behavior that can cause your account to get flagged, and the family money transfer that can quietly become a tax problem if you aren't paying attention. Stay with me, because the third one represents the exposure that the greatest number of retirees already face without having the slightest idea. I'm Lona Hart. Each week, I break down financial and legal subjects in straightforward language so you can safeguard what you've worked to build and make your retirement years easier to navigate. If that sounds worthwhile to you, go ahead and hit subscribe so you're notified when the next one drops. Rule 1. The $10,000 figure doesn't tell the whole story. Most people who are 60 or older grew up knowing one specific number, $10,000. Stay beneath it and everything is fine. That was never completely accurate, and it holds even less truth today. Under the Bank Secrecy Act, any cash-based transaction, whether that's a deposit, a withdrawal, or an exchange, that totals more than $10,000 within a single business day obligates your bank to submit a currency transaction report to FinCEN, which is the Treasury Department's Financial Crimes Enforcement Network. This requirement exists because the regulations that carry out the Bank Secrecy Act compel financial institutions to file documentation of cash transactions that surpass $10,000 in daily aggregate totals. That report contains your full name, your home address, your social security number, and the complete details of the transaction, and it gets submitted electronically within 15 days. You won't receive a copy of it, and the person at the teller window isn't going to walk you through the process. It all takes place behind the scenes, exactly as it has since Congress established the $10,000 threshold back in 1970 and reinforced it through subsequent legislative updates. What has changed is what compliance software is monitoring around that number. Banks currently operate pattern detection systems that flag accounts showing repeated deposits or withdrawals that cluster just beneath the $10,000 mark, particularly on accounts that regularly receive benefit payments, retirement distributions, or recurring transfers from family members. The threshold itself hasn't been adjusted, but the activity surrounding it attracts far more automated scrutiny than it ever did before. There is a second type of report that most seniors have never heard mentioned, and it doesn't require a large round number to get triggered. It's referred to as a Suspicious Activity Report, or SAR. For a bank or credit union, the regulatory minimum for a mandatory SAR filing is set at transactions totaling $5,000 or more that are connected to activity the institution considers suspicious. Though financial institutions also have the discretion to voluntarily file one on smaller dollar amounts if their internal monitoring systems identify something that seems off. In either case, the report is produced by software that watches for behavioral patterns rather than simply the size of a single transaction, and you are never informed when one has been submitted. Federal law actually makes it a criminal offense for any bank employee to alert a customer that a SAR exists in relation to their account, with penalties reaching up to 5 years of imprisonment. One additional detail worth keeping in mind: money orders, cashier's checks, and traveler's checks purchased using cash in amounts between $3,000 and $10,000 require the institution to confirm your identity and retain a record, even though no currency transaction report is triggered at that dollar level. It's a lighter version of the same documentation trail. And this applies across the board, including credit unions. If you transferred your money to a local credit union under the assumption that it exists outside these rules, That assumption is incorrect. Every federally insured institution operates within the same Bank Secrecy Act framework. There is no exception granted based on the size of the financial institution. The genuine protection doesn't come from switching where you bank. It comes from understanding what actually causes a report to be generated in the first place. Rule 2. The ordinary habit that can resemble evasion. That brings us to Rule 2, the one where a completely innocent daily routine can turn into a federal flag. Consider Diane, age 67, a retired county clerk from Albuquerque. For 11 straight years, she withdrew $800 in cash every 2 weeks to take care of household expenses. After her husband passed away, she raised that figure to $1,000 to cover bills he had previously managed on his own. 6 weeks after that change, her bank's monitoring software flagged the account and a SAR was filed. Diane hadn't done a single thing wrong. She was a widow who was adjusting her budget, but the software interpreted her new consistent pattern as a possible attempt to deliberately structure her transactions. She didn't find out about the report until several months later, during a routine account review, when a compliance officer asked her to explain the shift in her withdrawal behavior. She was able to resolve the situation because she had held on to the receipts that showed the increase lined up directly with bills she had taken over. But right up until that conversation took place, she had absolutely no idea that anything had ever been submitted. This is known as structuring, and it is defined under Title 31, Section 5324 of the United States Code. Critically, it does not require any proof that you intended to break the law. A pattern that simply appears to be an effort to remain beneath the reporting threshold is enough to invite scrutiny, regardless of where the money originated or how completely legitimate it is. If you regularly deal in cash, the solution is basic documentation, a single line written down each time, date, amount, purpose. If you're moving a larger sum between your own accounts, do it as one consolidated transfer rather than several smaller ones spread across multiple days. And before you get to the action steps toward the end of this video, take a look at your last 90 days of account activity. If you notice 3 or more deposits or withdrawals landing somewhere between $5,000 and $9,500, make a note of that. You'll want that information later. Rule 3. Money that never felt like income. Now we arrive at the rule that involves money that doesn't feel like income at all. Your daughter sends you $400 toward groceries. Your son Venmos you $600 to help with a car repair. None of that feels like something you should owe taxes on. And here's where the rules have actually shifted more in your favor than most people have come to realize, though the confusion surrounding them remains widespread. For a period of time, Congress and the IRS were moving toward dramatically lowering the reporting threshold for platforms like Venmo, PayPal, and Cash App, first to $2,500 for the 2025 tax year, with intentions to push it further down to $600 beginning in 2026. That direction created a significant amount of concern among retirees who routinely receive financial help from their adult children. But that lower threshold was reversed under the One Big Beautiful Bill Act, which was signed into law in July 2025. The reporting threshold for Form 1099-K reverted back to the level that was in place prior to 2021. Third-party settlement organizations are not required to issue the form unless a payee's gross reportable payments exceed $20,000 and the number of individual transactions surpasses 200 within a calendar year. So for the 2025 and 2026 tax years, casual family transfers involving a few $100s here and there are highly unlikely to trigger a 1099-K from the platform itself. That said, 3 things still deserve your attention. First, a number of states have established their own significantly lower reporting thresholds, some as low as $600, so depending on where you reside, a form could still arrive even if the federal threshold hasn't been crossed. Second, Zelle operates differently from Venmo, PayPal, or Cash App because it processes transactions as a direct bank-to-bank transfer rather than going through a third-party settlement network. For that reason, it isn't subject to 1099-K reporting requirements at all, regardless of the total amount involved. Third, and this is the element that hasn't changed, if money you receive is genuinely income from a business activity rather than a personal gift, it's taxable whether or not any form was ever produced. The absence of a 1099-K does nothing to eliminate that obligation. Here's where people still run into trouble. If a platform does cross the threshold and issues a 1099-K and you don't account for it on your tax return, the IRS's automated matching system identifies the discrepancy. The notice that follows is called a CP2000, not a formal audit, but a proposed adjustment to your tax bill with interest added on top. Consider Patricia, age 71, a retired home health aide from Memphis. She received a CP2000 in March, indicating she owed $1,840. She hadn't been employed at all that year. Her 3 grown children had sent her roughly $3,200 combined through Venmo over the course of the year to help cover prescriptions, utility bills, and a replacement refrigerator. Some of it through an account that had been categorized as business-related, and some of it in a state where a lower state-level reporting threshold applied. The IRS matched the form against her return, identified the gap, and gave her 60 days to respond before the proposed adjustment would become automatic. The solution is simple. Ask family members to include the phrase "personal gift" in the memo line whenever they send money. And keep a basic running record of what came in and for what reason. Gifts are not considered taxable income to the person receiving them, but you need to be in a position to demonstrate that's exactly what they were if a form ever does get generated. One additional piece of information worth carrying with you: the IRS generally has 3 years from the date a return was filed to question what was submitted. That window stretches to 6 years if the unreported income represents more than 25% of what was originally declared. What that means is that a discrepancy from 2 or 3 years back can still resurface today, even if no notice ever showed up at the time. If you've been receiving ongoing assistance through payment apps for several years without keeping any kind of log, it's worth pulling your transaction history from those platforms going back a few years, not just the current one, your action plan. Now, before you leave, here is your step-by-step action plan in sequence. Step 1. Request your free ChexSystems report and review it for any flags or account closures you weren't previously aware of. Step 2. For the next 90 days, log every recurring deposit, the source, the amount, and the date. If a family member sends you money through an app, ask them to include a one-line note confirming it's a personal gift. Step 3. Consolidate any transfers you plan to make between your own accounts into a single movement rather than several smaller ones, and include a brief memo describing what the transfer is for. Step 4. Add up every payment you've received through Venmo, Zelle, PayPal, and Cash App over the past 12 months. If any single platform crosses $20,000 and 200 transactions, or your state's lower threshold, and it isn't reflected on your tax return, begin gathering your documentation now before a CP2000 ever arrives. Step 5. If a CP2000 does show up, respond to it in writing before the deadline printed on the notice. Typically 60 days from the date it was issued, not the date you actually opened it. Include a concise explanation, your supporting documentation, and a signed statement. If the proposed amount exceeds $5,000, bring in a licensed tax professional before you submit your response. Step 6. Place a free security freeze on your ChexSystems file if you have no plans to open new accounts in the near future. It won't affect any of your existing accounts, but it does limit how your transaction history gets shared with screening tools going forward. Not one of these 3 realities arrived with any kind of warning attached. Your bank is legally prohibited from telling you a SAR was filed against your account. A payment app won't send you a notification when it reports a family transfer. That silence is deliberately built into the structure of the system. Understanding the actual rules that apply to you and keeping consistent documentation as you go is what prevents a quiet background flag from ever growing into a serious problem.